Welcome back to Wall Street Confidential on the Street.com TV. Jim, we saw a number of upgrades today, particularly in the tech sector.
Right, except for of Juniper, which I think was a bad downgrade. That was valuation versus Cisco. But Hewlett-Packard on that for ActionAlertsPlus.com gets upgraded. Let's use that as an example. Hewlett-Packard has been saying the whole time that there's been no slowdown. The whole time. From their December analyst meeting to just the other day. And yet the stock has gone from 53 to 44. So what happens is once the Fed seems to have switched and made things better, it brings people out of the fallout shelter and says, listen, maybe I can upgrade Hewlett-Packard. We know the fundamentals are fine. I believe that we will see the same thing with Intel next week. I think that Intel at 22 is attractive to 25. I think Hewlett at 45 is attractive to 50. These are only for the nimble because if there truly is a slowdown, these stocks will go back down again. But what I see happening, and by the way, Honeywell, not a tech, but I saw that too. Companies that have been reaffirming and saying things are fine have been hit just as hard as companies that have not reaffirmed and you don't know whether they're fine. So it's a good opportunity for analysts who are thinking, you know what? The environment could get better for big enterprise. If big enterprise gets better, that's good for Hewlett-Packard. Maybe notebooks aren't that bad. And then they reiterate or they upgrade. I've seen this time and time again. One of the things that people don't understand is there's a lot of people who talk about when you cut rates, it's pushing on a string. There's other people who say, look, it doesn't really matter. But people don't understand that most of the pundits, the bears, don't understand. Most of what drives markets is confidence. If you have confidence in the future, then therefore you think the earnings estimates are too low in the future. Earnings estimates are what drives appreciation in stocks. So if confidence improves, earnings estimates we feel more certain for, or we think that they're too low, so we buy stocks. This is what happened in almost every turn in the now the 29 years I've been trading. And it's very hard to understand because it's all psychological. Mm-hmm. People always want to, and there's so many quant funds too, but people always want to make this into a science. It's not a science. It's about psychology. Fed rate cuts change the psychology, make it so you're more bullish in the future.
But you've called the Fed so wildly inconsistent. What happens if they shake confidence again?
Well, if they change their mind again, then we'll go right through 12,500.
Okay.
Yeah, and that's how it'll be catastrophic for the market. There are two Fed officials, Thomas Hoenig from Kansas City and Dick Fisher from Dallas. They're very powerful. Bernanke runs a very decentralized Fed. He lets anybody talk. He has kind of a debating society. I think he's a very weak Fed chairman. And by the way, I keep waiting for others to say that on air. I guess they're afraid or they want the interview or they just feel like that you can't criticize. And I'm from a different ilk. I think this whole debating society Fed has really put us in jeopardy and makes me always say, keep one foot out the door until you're sure that they mean what they say.
So in this time right now, are you looking to Hewlett-Packard?
Yeah, definitely. Hewlett-Packard's a great trade.
Okay.
Now, options expiration coming up looks like it might be pinned to 45, but I do think it could break to 47.
And you did mention Intel. What's your stance with the situation?
It's at 22.5. It could be pinned there next week, but I do think it reports on Tuesday, and I suspect it's in line. And if it's in line, the stock goes higher.
Okay, thanks, Jim. Stay tuned for more Wall Street Confidential on the Street.com TV.